Now C of P is equal to, what is C of P?
Planned cost.
Planned cost, right? Now, so here actual cost divided by planned cost into planned cost. So this will get cancelled. Your calculated cost is nothing but cost affecting, that is calculated cost, this one. This cost affecting net income, revenue affecting net income. So cost affecting net income is nothing but cost of sales. Cost affecting net income is nothing but C of PA is nothing but C of PA is nothing but cost affecting net income. What do you mean by that? Okay.
Actual cost, sir.
No. Cost affecting net income. The meaning of this.
Oh,
What is the meaning of that? Just you read that properly multiple times.
yes.
Revenue affecting. See, this rain is affecting my play,
Oh,
right? What is the meaning of that? So, whenever we are preparing the income statement, the cost that are contributing in the income statement, whenever we are preparing the income statement, revenue that is contributing on the income statement, that is the meaning. So, say for example, for this much of cost, how much revenue I have to get? Okay, then my revenue minus cost is my profit, right?
yes, sir.
Cost affecting net income. Net income means the difference that is calculated between the cost, revenue and cost, right? So this is the contribution. This cost is contributing in the net income. This revenue is contributing in the net income. That is the meaning. Understood, right?
Yes, sir.
Yeah. This much cost portion is involved, this much revenue portion is involved, that we are calculating, right? Yesterday I have told the formula, revenue affecting net income or calculated revenue is nothing but POC into planned revenue. For 90,000, okay, actual cost, what is the equivalent value of actual revenue that we calculated yesterday? Something around 1,80,000. You remember?
Yes, sir.
So
Yes.
that means that is the revenue that is affecting net income based on the cost that are available on the project. That is the revenue affecting the net income. In case of cost based POC, in case of revenue based POC, this is the cost that we need to show in the balance sheet or maybe in the P&L. Sorry, in the P&L. Okay, this is the cost it has to incur based on the revenue that is recognized. That is the meaning. Okay. Here, the second case is this is the revenue that needs to be recognized based on the cost incurred. That is what yesterday we discussed, right?
Yes, sir.
So the percentage of, so up to here it is clear, no? All this terminology, these are important. Okay. These are very important, little confusing. That is the reason I gave here in a detailed way. Okay. You understood how this CA is coming, right?
Yes, sir.
Okay. The percentage of calculation, percentage of completion can be calculated on the basis of the following data. What is the data? Planned revenues, planned cost, planned quantity, actual revenues, actual cost, actual quantity. Let us say, for example, you are using quantity based method, then actual quantity divided by planned quantity. You are using cost based method, actual cost divided by planned cost. You are using revenue, actual revenue by planned revenue, like that. Okay, sorry. So these are the formulas that you need to remember. In case of cost-based POC, we are applying this. Okay, in case of cost-based POC, the calculated revenue cost-based POC method, we are going to calculate the revenue affecting net income. In case of revenue-based POC, right? This is the method. Okay. The method of calculating the cost affecting net income or revenue affecting net income. The percentage of completion can be calculated on basis of the following data. So whenever, see, some of the projects they will tell we don't have any planned cost, we don't have any planned quantity, something. These scenarios you will come across. Even I too faced in some of the projects, they are mobilizing the equipment, material, everything without having any planned cost. Then how to calculate my POC as per the SAP standard? It is telling that these are the parameters to calculate the POC, right? These are the parameters that are required to calculate. These are the parameters that are required to calculate the POC. So here, if you see, I need actual cost or planned cost in case of this method multiplied by my, for example, actual cost divided by planned cost into planned cost. In this method, I need actual cost divided by planned cost into planned revenue. So to calculate the POC, the three parameters which I need is, sorry, in case of POC, not in this case of cost affecting net income. In case of POC, I need either the actual cost or planned cost or actual cost, actual cost divided by planned cost multiplied by planned revenue. Okay, that means I need these minimum parameters. Okay, I need these minimum parameters which I have to calculate. So here, this thing is cost affecting net income. So capitalized cost. So this is costs affecting net income. Okay, not for this revenue based method. I am sorry. This is for calculating the cost affecting net income. Okay, this is for cost affecting net income. Sorry, I am sorry. This is not, because for revenue based method it is uh, actual revenue divided by planned revenue, POC calculation. Okay, this is cost calculation for this method. Okay, I am sorry, I did not observe it properly. Okay, so now if you see here, the parameters actual revenue divided by planned revenue. Where is the planned revenue? Actual revenue, actual cost, actual quantity. This one is planned revenue. Okay, so in the revenue based method, okay, the value is actual revenue, revenue based method, actual revenue or of A divided by R of P. This is the percentage of completion multiplied by planned cost to calculate the calculated cost. That is equal to R of A divided by R of P into planned cost. Right? This is for the revenue method. Okay. Now the same thing explained here. The system can calculate resultant as data using the percentage of completion. This data includes, okay, result analysis data. So based on the POC, okay, for example, based on this POC, based on the POC formula, POC, this one, this is important for us. Based on this POC formula, what it is telling is, it will calculate the capitalized cost, that is how much cost incurred and what is going to the inventory, reserves for unrealized cost, revenue in excess of billing, revenue surplus. Okay, revenue in excess of billing means POCI. Yesterday, the RA category that we were discussing, POCS surplus. Okay, revenue affecting net income. Okay, that is nothing but calculated revenue. Cost affecting net income, that is the costs, actual costs that were incurred, or cost of sales. Cost of sales or actual cost on the project. Actual cost on the project. Okay. Now, this results in the following formulas. These are the formulas. Revenue affecting net income or calculated revenue is POC into planned revenue. Cost affecting net income is cost of sales multiplied by planned revenue we give, but this is percentage of completion multiplied by planned costs. This is the two things that we need to remember. Okay, so this is important. Next, what it is telling is, see, in the revenue based method, the cost of sales is calculated as POC is equal to actual revenue by planned revenue. Result is, what is this? Revenue affecting net income, right?
Yes, sir. Revenue affecting.
So let me keep this formula as it is. Revenue based method. Let me keep it here somewhere. Revenue based method. If time permits, we will see both the methods. We will see that. The formula always holds good. This is also important. Whatever yesterday I was explaining, if the actual revenue and calculated revenue is greater than calculated revenue, like that. So if actual revenue is greater than calculated revenue, what will happen? The one which we received is more than the system calculated. What will happen? Yesterday I explained. Liability will generate, right?
Yes.
The one which we received is more than the one the system calculated. Okay, then it's a liability. If the received amount is less than the calculated one, then the contract asset, like that. Okay, so you need to remember this. Then,
That liability is unbilled revenue, no, sir?
yeah, unbilled revenue only, but in unbilled revenue, in case of liability, the revenue will decrease because we are supposed to pay him, right? So in
Yes,
the
sir.
balance sheet, we have to show revenue as a positive value, not negative. See, revenue always with the negative value is increasing, and expenses with positive value is increasing. Okay, that you need to remember. Okay, now let us go to this cost-based POC method. You can use cost-based POC method for sales orders, projects, internal orders with revenue, service orders with revenue, maintenance orders with revenue. So wherever there is a revenue involved, you can use this method. That is the meaning. Wherever there is a revenue, you can use this method. That is the meaning of that. Okay. So wherever there is a revenue, you can use in all the cost objects, you can use cost-based POC wherever there is a revenue involved. Okay. So let me put here cost-based POC method. So what are the objects? You can use this method for the following objects. So that means not only for projects, we can use it for sales orders, we can use it for internal orders with revenue, service orders in case of you sold some product or equipment to the customer, then there is a service involved in which the while performing the service, you will bill to the customer, right? So in that also revenue is involved. Maintenance orders with revenue. Let us say you are doing some maintenance activity, repair at site activities, or repair in-house repair activities for the customer. So those are also treated as a revenue objects. So hence the cost-based POC method can be applied. That is the meaning of that. Okay, these are the objects where we can apply the cost-based POC method. We are discussing now with the projects. So internal orders actually only in the old systems they are using. Otherwise, mostly absolute and PSC they are using. Internal orders they are not using mostly. Mostly internal orders they are not using. You just remember this. Next thing is with the cost based POC method, you can so what we can do with cost based POC method, calculated revenue affecting net income on the basis of actual cost. So on the basis of actual cost, we will try to calculate the calculated revenue. That is the meaning. Calculated revenue affecting net income on the basis of actual cost. This enables you to report a profit before any revenue has been received. So yesterday I told the first period cost is booked on the project, but there is no revenue. That means I did not raised any invoice to the customer. Still I want to report a profit before any revenue has actually been received. This is the statement that I was discussing yesterday. You remember? See why I am explaining this as it is. Whatever is there in the SAP means you will be able to understand very easily if I give the details of it, because yesterday the same point I explained, but I don't know how many of you understood this. Okay, same point I explained, saying that 90,000 my actual cost, revenue is zero in Excel. This is the statement that is telling, right? This enables you to report a profit before any revenue has been actually. So in the first period, we are not receiving any revenue, but we are still showing in the balance sheet, right? In the month end entries.
Yes, sir. Yes.
The same thing only. Okay. Calculated revenue affecting income on the basis of actual cost. This enables you to report profit. Determine the revenue in excess of billings. Determine the revenue in excess of billings. That is POCI. So, in case whenever there is no revenue, the entry that is going to generate is, I told POCI, that is balance sheet asset. Okay, that is an asset is capitalized. Okay, an asset is capitalized based on the calculated revenue value. When we compute the calculated revenue yesterday, we got 1,80,000. Okay, that is recorded with the RA category POCI. Revenue is excess of billings is nothing but POCI. That is the meaning. Okay. What is unrealized profit? Yet the profit is, that is, yet the revenue is not received but unrealized, yet not realized but unrealized profit we are showing in the balance sheet. That is the meaning of this. And these 3 points are very, very, very important. These 3 points are very, very, very important. Okay, if you understand these 3 points, first point is telling that based on the actual cost, I am calculating the calculated revenue. What is the formula for calculated revenue? What is the formula for calculated revenue? I told now in this class only multiple times. Can someone tell that? What is the
It is
calculated revenue?
POC into uh, uh,
Yes, POC into planned revenue.
okay.
So calculated revenue. So these statements you need to understand. Calculated revenue affecting net income on the basis of actual cost. So on what basis this is calculating? based on the actual cost incurred on the projects. This enables you to report a profit before any revenue. So in this case, in this case, even though there is no revenue recognized, we will be still able to record the profit on the project in the income statement. That is the meaning. We will see in the upcoming this one. POC method is often used in Britain and North America because German law does not allow unrealized profits to be reported. The POC method is used in Germany only for internal information purpose. Okay, this they are using for internal report. You have planned cost and revenues, that is prerequisite. So the prerequisite is that we must have planned cost and planned revenue. Prerequisites, you write here prerequisites, control X, sorry, control X, control V. So what is the prerequisite? Why this is the prerequisite? For calculating the POC, we need planned cost and planned revenue. Planned cost, you have planned cost and planned revenue. I will give here planned revenue. Okay. So the prerequisite is that we must have a planned cost and planned revenue. Why? Can somebody tell where it is interlinked? Can somebody tell where it is interlinked?
To calculate actual revenue, calculated revenue, we need POC, no sir. For POC, we need cost, and for calculated revenue, we need planned revenue.
Very good. Excellent. That is what I need. So you understood now. The prerequisite planned cost we are using in POC, actual cost divided by planned cost. In calculated revenue, we are using the planned revenue. So the parameter planned cost, we are using the POC calculation. The parameter planned revenue or the value of planned revenue while calculating the calculated revenue, we are using this. That is the reason I am telling, for any project requirement to calculate the POC, I must have a planned cost. If there is no planned cost, then what we are going to adapt? What we are going to adapt? We are not going to adapt anything if there is no planned cost. So SAP provided one more method saying that whenever you don't have a planned cost, copy the planned revenue as a planned cost. This enhancement is there, which is provided by SAP. Let us say some of the projects like unit rate projects, where they will be not able to do the any planning. Let us say on a ad hoc basis, they are mobilizing their equipment and manpower. So they don't know what is they are going to do in the site, in the project site. So and hence they won't be able to plan any activities on the projects. This they will quote. Most of the project customers, they will quote that we don't have any planned cost during the mobilization of my manpower because we don't know the scope. We just mobilize the manpower to the site, then they will assign the work that is required for them. Okay, whatever it may be available during the shutdown or maintenance, then the manpower will be allocated for that. But before in hand, they don't know what they are going to do, and hence they won't be able to do any network cost planning on the project, and hence we will be not having any planned cost on the project. So it is difficult for us to recognize or to calculate the POC and the calculated revenue without having the planned cost. In this method, whenever you don't have a planned cost, SAP is suggesting that copy the planned revenue as a planned cost, right? This is what they are suggesting. So that you can check in Google also. It is there, that method. Even I applied in one of my real-time project. Okay. So these are the formulas. These are the formulas for the cost-based POC for cost of sales and revenue calculation. So these are the features. This is very important. So these two things are the things that you need to remember. Formula for calculating POC and formula for cost of sales, formula for revenue affecting net income. So if you remember these, for calculated cost and calculated revenue, if you remember these, okay, this is what all about the RA. Only these formulas will play a key role along with the parameters that we are using, planned cost and planned revenue. Okay, anyhow, actual cost will come based on the execution of the project. But the prerequisite is that we must have a planned cost on the project and planned revenue. Understood, no? Pawan, any queries up to here?
No, I've got it.
right? So this up to here, if you understand these formulas, based on this only system will save the result analysis data, and further when we settle, it will post the accounting entries. If you understand these things clearly, that is more than enough. Okay. These three formulas and these prerequisites are very, very, very important. Okay. And especially this one. This is the master player in generating the result analysis data. This one, calculated revenue, POC into planned revenue. Okay, this calculated cost anyhow is equivalent to the actual cost of the project. So this you can remember very easily. But this calculated revenue, you need to remember POC into planned revenue. Okay, this thing very important. Calculated revenue formula is very important. Okay, let us go to the example now. The cost affecting net income equal to the actual cost. That means, see here, this formula it is telling cost affecting net income is equal to the actual cost. Let me put it here. I will share this document also, or you can search in the Google also. That is not an issue. See, this is the meaning of that. Cost affecting net income is equal to C of A is nothing but actual cost. A for actual, C for cost, right? So that is the meaning of that. Tomorrow, even if you refer this SAP site, when you have some confusion, you will understand that is the reason I am following this instead of telling on my own. Okay. If actual the cost can be allocated to COPA together with the revenue affecting net income. So along with the revenue affecting net income, the cost can also be moved to the COPA. That is the meaning. These costs can be allocated to COPA along with the revenue affecting net income. If actual revenue, see, these costs, so let me put the same sentence. So that means we are moving this data to the COPA. That is the meaning. Okay. Actual cost we are moving to the COPA simply. If actual revenue is greater than the revenue affecting net income, system creates a revenue surplus. This is what the statement yesterday I told, right? POCS will generate, right? So, for example, if calculated revenue is greater than actual revenue, what it will do? Can somebody tell? If calculated revenue is less than, tell me now. Can anybody tell what this will do? If you understand this formula and these conditions, can somebody tell now if calculated revenue is greater than the actual revenue? Calculated revenue means based on the POC and planned revenue, system is calculating the actual revenue is the revenue that is booked on the sale order with respect to the project as a invoice value, right? When we pass to the accounting. Now you tell
So
me
it will
if
generate liability. Yeah.
no. If calculated revenue is greater than the actual revenue, right, right. Sorry, liability.
Yes, sir.
Okay, because sorry. This is not liability. Yeah. Actual revenue we are not raising, right? This is asset. Okay, because my calculated revenue is greater than, let us say that means I will put here, for example, my calculated revenue is 1,80,000. For example, I am taking my actual revenue is 1,50,000. Okay, calculated revenue, my actual revenue. That means I am supposed to receive 1,80,000, but I received only 1,50,000. So it's a contract asset, right?
Yes, yes, sorry.
This is what the condition is. Next is if calculated revenue is less than the actual revenue. Let us say my calculated revenue is 2 lakhs, for example. That means some more cost is posted and my calculated revenue has become 2 lakhs. But my actual revenue, if calculated revenue is less than the actual revenue, my actual revenue is 2,50,000, for example, then contract liability, because I received contract liability. Because I received more than the anticipated value. What is the anticipated value? Because as per this calculation, I was supposed to receive this much only based on the cost incurred, right?
Okay.
But
Yes,
I
sir.
am receiving more than the anticipated value or the system as per the empirical formula that we are applying here, this one. It is supposed to receive this much, but I am receiving more than that. That we will see with the SAP example. Just remember this, okay? I gave some, let us say here, some cost is applied. So based on that, this revenue calculated. Here some cost, additional cost incurred. Based on that, this is the value that system calculated, but recognize this value. You recognize this much revenue. Okay, that is the meaning. Okay, understood, no?
Yes, sir.
So to play with this, what is the key factor here? The actual cost is varying on based on the progress of the project, right? Based on this only it will calculate, right?
Yes.
So that is the meaning of that. So let me go to now. So if the actual revenue is greater than the revenue affecting net income, system generates a surplus. The revenue surplus is basically a reserve. So what it is telling, if actual revenue is greater than the, that means a liability, surplus or liability. That means, what does it mean here? Let me put, okay. So this is POCS, this is POCA. These two value RA categories it will record simply. Okay. After executing the RA, if you see at the database level, if it is a contract asset, POCI, if it is a surplus, then this one. That is the meaning of that statement. Understood, no? Okay. So if you understand up to here, I think that's enough. Then we will continue because I have some personal work. Sorry, if actual revenue is less than the revenue affecting net income, uh, revenue in excess of billings. Okay, this is what revenue in excess of billings is, POCA. Okay, so let me put it here, these two, right? So you understood this up to here. I will share this Excel also. Go through this, read this. Okay, this only concentrate on this cost based POC method. Then maybe we will continue in the evening. Okay, with the execution of this one. And I will ask every one of you all these formulas and what is the basis for this. Okay, in the evening. For 10 minutes, I will do that only. Okay.
Yes.
Okay. Then we will execute period one, same data we will execute. We will run the RA. Then I will show. For how many periods they ran? I think for 4 periods he used. 4 periods we will run and I will show the results. So don't miss evening class. And meanwhile, you need to go through this. Even the blog also I will share if you are not able to understand the Excel. Go through this and let me know by evening. You need to tell me everything. Okay. I want to know. This is very important topic along with the settlements. I am sending this in WhatsApp. See and try to understand this billing process also. This also very important. So you need to read on your